Now, sometimes students get accounts receivable and accounts payable mixed up. So over the next few slides, we're going to go and get some practice with doing some account receivable transactions and some accounts payable transaction. So we are going to play the part of Mary. Mary owns a lawn mowing service. She mows lawns. So as you can see down here in the lower left, she's starting off with $0 of cash, $0 of AR. Now AR, remember, stands for accounts receivable. And looks like she has a mowing revenue of $0, so she must be a brand new business. So now we're going to explain the process called a customer buying on account. What does that mean? Well, we'll find out. So Mary agrees to mow a customer's lawn once a month and allows the customer to pay 2 weeks later. So Mary's mowing service mows the lawn and the customer agrees to pay $50 in 2 weeks. This means a transaction has occurred. So what should Mary record? Now remember, every transaction has to affect 2 or more accounts. Why does it have to affect 2 or more accounts? Well, because the accounting equation must balance after each transaction. And the accounting equation cannot balance if you only affect 1 account. So in this case, what do you think are the 2 accounts that are going to be affected in Mary's mowing business? She's going to record the amount in mowing revenue and accounts receivable. In the future, Mary's business will receive payment from the customer. That is why it's called a receivable from Mary. So Mary would record mowing revenue of $50. Now we're just going to record the changes to the accounts in this informal manner over here on the lower left. And the other account is accounts receivable, AR. So mowing revenue increases by $50, and now her customer owes her $50 because this is a receivable. She's going to receive this in the future from the customer. So here's where the tricky wording comes in. Your textbook sometimes does not make it easy on you. Instead of saying, Mary mows a customer's lawn and the customer promises to pay later, which is easy to understand, your textbook will instead say something like, Mary mows the customer's lawn on account. So if it says Mary mows a customer's lawn on account, you need to know that the customer is agreeing to pay later. So no cash is being received by Mary now. So now, let's look at the other side of the transaction, the customer side. If the customer kept personal accounting records and asked you to help with the records, what would the customer record after their lawn was mowed? Now remember, they're agreeing to pay in the future. So because the customer is agreeing to pay in the future, the customer would record accounts payable. Now AP, remember, means accounts payable. And because 2 accounts must be affected, 2 or more, the other account would be an expense called mowing expense. Now it's 2 weeks later. The customer pays $50 to Mary's business to pay the customer's account. Let's go back to Mary's side. What happens to Mary's cash account when the customer pays her $50? Well, obviously her cash account increases. Now, does that customer still owe her the $50? In other words, should we get rid of this accounts receivable? Of course we should. The customer no longer owes Mary $50, so Mary will have to decrease the AR by $50, so it's now 0. So now Mary's business has $50 cash and mowing revenue of $50. If the customer was keeping personal accounting records, what would happen to the customer's records? Well, let's start with accounts payable. What happens to the customer's accounts payable? the customer no longer owes that, so they would have to get rid of the accounts payable. And of course, they would be paying cash, so their cash would decrease by $50. We didn't have room to show the cash. So again, the textbook sometimes makes things harder than it should be. Instead of saying the customer pays $50 to Mary's business to pay their account, the textbooks will say something like the customer pays on account. So if it says the customer pays on account, this means Mary's cash increases. AR would decrease because Mary's business no longer has a right to receive the $50. So a quick summary of accounts receivable. So if Mary's mowing service sells a service on account, we now need to know that this means the customer will pay later. So what accounts are affected if Mary's mowing service sells a service on account? She would have to record an increase in accounts receivable because the customer now owes her money, and she would record some type of a revenue, and since this is a mowing business, it would be mowing revenue. And then later, oh, I forgot. So remember, rule number 1, a transaction must affect 2 or more accounts. So we do have 2 accounts being affected. Now later, the customer is going to pay her. So the book would say something like, customer later pays on account. So this means the customer has paid her debt to Mary. I should say his or her debt. We don't know the gender of the customer. So Mary's business would record a decrease in AR because it can no longer collect that from the customer. And then Mary's business would record an increase in cash. So now let's do some examples of accounts payable for Mary. For this example, we're going to ignore the mowing revenue and the accounts receivable accounts because they have nothing to do with accounts payable. So we're going to look only at repair expense, cash, and accounts payable. So Mary and her business have $50 of cash, and she needs to get her company's lawnmower repaired. So in comes the mobile mower repair business. So the mower repair service agrees to repair Mary's mower and lets Mary pay in the future. So Mary is buying a service on account. On account means she's going to promise to pay later. So the mower is repaired and Mary gets an invoice, which is just a bill. And the bill says she owes $30 for the repair. She will pay it later. So what does Mary record on her records? She has to record an expense because this is a part of the cost of doing business. And what was she spending the money on? She was spending it on getting her mower repaired. So it's repair expense. And now she owes money. She owes $30. So she would have to increase her accounts payable. So she now owes $30. But of course, the book can't make us seem or make it sound too easy. So instead of saying Mary gets her mower repaired and promises to pay later, the textbook homework will say something like Mary had a mower repaired on account. So if it says that on account, you know that she's going to pay in the future. She's not paying now. So now the repair service technician, he's really good at repairing mowers, but he has no idea what accounting is. So he asks you what will happen to AP and AR for his business. Well, the answer is the repair company's accounts receivable would increase by $30 because now he has the right to receive $30 from Mary in the future. So his AR is now $30. And since he repaired her lawnmower, he would record a repair revenue account because he has sold a service. Now let's talk about paying off accounts payable. So we're going back to Mary's side now. So 2 weeks later, Mary pays $30 to the repair business to pay off her account. What happens to her cash account? Previously, it had $50 in it, and she now owes $30. So she's going to pay the $30. So obviously, her cash is going to decrease by $30. She had 50 in it, so now it has 20. But that's only one account that's affected. We have to figure out what other account is affected. So when Mary pays, what's going to happen to her AP, her accounts payable? Obviously, her accounts payable is going to decrease by $30. So cash decreased by $30 and her accounts payable decreased by $30. So the repair technician, he's fascinated with accounting and he wants to know what's going to happen to AR or AP on his side of things. The repair company's AR will decrease by $30 to zero. And then what happens to cash? Well, his cash will obviously increase by $30. So here's my warning about the vocabulary. So your textbook, instead of saying something like Mary pays $30 to the repair shop to pay off Mary's account, your textbook will instead say something like Mary paid $30 on account. So we need to know that this means Mary's cash decreases and her AP decreases because Mary's business no longer has to pay the $30. So now let's do a quick accounts payable summary. So if Mary's mowing service purchases a service on account, what this means is Mary will pay later. So Mary's business would record an increase in accounts payable since she now owes that money. And she would record whatever it is she's paying the money for. In this case, in our example, she was paying the money to get her mower repaired. So that would be called mower repair expense or just repair expense. And notice we did affect two accounts. Now later, Mary's going to pay on account. So if the book says a Mary pays on account, we need to know that this means Mary paid her debt. So Mary's business would record a decrease in her debt, AP, accounts payable, and she would record a decrease in cash. So now let's do one more contrast between AR and AP. Let's say you buy a cell phone from a company creatively called Phones Incorporated, and you pay for it with a credit card. So this means you get the item now and are promising to pay later. So you are buying on account. So how does that affect your AR or your AP? For you, this creates an accounts payable. You must pay in the future. And of course, we would also record the fact that we got a phone, an asset. Now, how about for Phones Incorporated? What would they record when you bought a phone on account from them? Phones Incorporated would record an accounts receivable because they have the right to receive the payment in the future. So vocabulary-wise, you need to know that buying now and promising to pay later is called buying on account. And you need to know that selling something now and allowing the customer to pay later is called selling on account. So let's do a little quick quiz here. See if you can fill in the blanks. What is an unwritten promise to pay the creditor? Remember, creditor is someone to which you owe money. So to me, that sounds like accounts payable. Question number 2. What do you call the amount of the assets that others own? Well, that's just another way of saying liabilities. Next question. What is the total value, or what do you call the total value of items owned or partially owned by a business? In other words, all the things a company has. Those are called assets. And what's another word for debt? liabilities. And what do you call the amount of the assets that the owner owns? So notice previously we asked the amount of the assets that others own. This is the amount of the assets that the owner owns. This is called equity or owner's equity. And the equity account for a sole proprietor is called the capital account. So we would accept capital as the answer too. And one more quick little self-quiz. This one is trying to figure out if you know if these accounts are an asset, liability, or are they part of owner's equity. So how about an iPad? Is that an asset, liability, or is that part of owner's equity? Well, obviously that's an asset. How about accounts receivable? Is that an asset, liability, or part of owner's equity? Well, this gives you the right to receive cash in the future. So it has a future benefit, a future value. So that's an asset. How about accounts payable? This one should be easy. That's debt, also known as liability. And cash? Cash is everyone's favorite asset. How about Jane Doe, capital? So Jane Doe must be the owner's name, and capital is a type of owner's equity account. And then finally, what if a company has a digital camera? Well, that's something that it has or something that it owns, so that is an asset. And that's it.